So let's now move on and look at two more strategies of entry deterrence: limit pricing and predatory pricing. Both refer to aggressive pricing at some point. However, limit pricing is about before entry happens, i.e. ex ante, whereas predatory pricing is after entry has happened to try and drive existing competitors out of the market. But let's first focus on limit pricing. The intuition is that you're keeping prices low despite the fact that you have a monopoly position, which may seem strange because why throw away money? Why not make the profits that you can if you are a monopolist? Well, if there is a potential for someone to come in and take market share off you, then keeping prices low may send one of two signals, or both types of signals actually. You're signaling to the potential entrant that either there's low demand and the market that you, dear entrant, are trying to enter is not an attractive one. So don't bother coming in. Another signal that you might send is that you are a low-cost incumbent. So, dear entrant, if you come in, you would face a very dangerous and very aggressive competitor. Again, this would be a signal that makes it less attractive for an entrant to jump into the market and try and take market share off you. Now, this only works if we have incomplete information. So there must be some uncertainty about either low demand, or the shape of the demand curve, the nature of demand, or there must be uncertainty about the cost structure of me as an incumbent. In that case, this can work. Limit pricing can work. So it's actually difficult to think of examples for limit pricing, because if limit pricing is successful, you're not going to see entry, and then it's difficult to see if this was limit pricing or if it was one of these two justifications, i.e. either low demand or low cost. Now, one example that I think works fairly well is the example of the Fairies and the Eurotunnel. So, as you may know, there was for a long time there were ferries going between UK and France, and the starting point was Calais, the end point was Dover, and so these ferries were going back and forth between the two countries. And this market was traditionally dominated by two players. It was dominated by P&O ferries and Stena lines. And they interacted very heavily. They've interacted for a long time. They were producing, or they were offering identical services, and they had identical cost structures. So they were fairly cozy as a duopoly. Now then, there were rumors, and these rumors actually persisted for a long time, that a tunnel would be built between a place close to Calais and Folkestone. Okay, so very clear, very close substitute to ferries between Calais and Dover was the tunnel that would just as well take cars from France to the UK or from the UK to France. Now, as these rumors became more viable, as it became more and more likely that a tunnel was actually going to be built, both P&O and Stena lowered prices by about 50%. And they might have sent the signal that, first of all, this market isn't very profitable. Second of all, we do have an efficient cost structure. We have low cost. And if you are thinking of building the Eurotunnel, then you better adjust to the expectation that prices are going to be fairly low. Now, they did this in combination with another strategy, which was just by upgrading their fleet. So both P&O and Stena were buying new ferries to indicate that now technologically they have better technology, they have better production process, they have a better service, and that means that they can actually sustain this lowered price for a longer period. After the Eurotunnel eventually was being built, so the potential entry deterrence did not work. The tunnel was being built, Eurotunnel was opened, and then P&O and Stena just merged to form one company, and they raised prices again to the initial level. And that, to me at least, is a fairly good indicator that probably limit pricing was exactly what they attempted. Because if they hadn't attempted that, or if that was not the intuition behind it, then even after entry of the Eurotunnel, the most likely response would have been to lower prices even further rather than go back up in prices. So even though it was not successful, I think limit pricing in the case of the Fairies and the Eurotunnel as a potential entrant is quite a good indicator. So the second pricing strategy is predatory pricing. Predatory pricing can be if you have an entrant, if you have a competitor, and that competitor will end up being driven out of the market or be lowered in their market share. So predatory pricing refers to charging low prices, even prices below marginal cost, in a currently competitive situation. Again, you're trying to induce exit, you're trying to drive players out of the market, or deter future entry. Again, this is only going to work if there is incomplete information, because if you were just to lower prices and everyone would know that eventually you want to go back up in prices, that just wouldn't be a successful strategy, because then no one would enter, because everyone would anticipate that eventually you're going to go back up. So one example of predatory pricing, which was fairly heavily discussed and also investigated by antitrust authorities, is the example of the UK newspaper industry. And so in the newspaper industry in the UK, you have a number of different players, including the Times and the Independent, both of which are considered quality newspapers. So you've got the Times and the Independent, maybe slightly different in terms of their political leanings, but in principle both will be considered quality newspapers, or broadsheets as they're called in the UK. So in 1992, both of them were charging the same price, and both of them pretty much had the same market share, so they were selling the same amount of copies. Then in 93, what happened is that the Times was on a mission to lower prices. So they went from 30 to 20, slightly back up to 25, and then settled on 35 pence. The Independent didn't quite manage to respond in kind. So they even increased prices here, and then they eventually lowered prices, but they ended up always at a higher price. If you look at the end prices, they were slightly more expensive, so they were 45 pence versus 35, but the Times had a market share that was much, much bigger than the Independent, more than 3 times as big as the Independent. So you can see here that by lowering prices, the Times was successful in marginalizing a competitor, the Independent. Of course, this was something that was, as I mentioned, was heavily discussed, and the Times was simply arguing that they have an efficient market, an efficient production process that lets them charge equilibrium prices of 20 pence. So it's actually cost efficient, or covering the cost of production to charge just 20 pence, for example. Okay, they were not doing this for predatory reasons, but simply for reasons of aggressive competition. And that's a fine distinction, but it may be it's an important one in terms of antitrust authorities. So predatory pricing and limit pricing, we've seen just now, are powerful strategies, 2 powerful strategies that can be used to keep a potential entrant out of the market. There's one more that's actually equally powerful, which we'll discuss in the very last video. But first of all, do try the in-video quiz, and in the meantime, I'll just have a bit of a break.